So this particular session is a session about state and local taxes, and in particular, 5 sales tax hotspots for online sellers. And this is a very hot area. As you know, I'm sure if you're at all involved in state and local taxes with your clients or your own business, you know that this is an area where we have pending legislation in Congress, and a lot of people are kind of on tenterhooks to see what's going to happen in the state and local tax arena in the years to come. So with us today, we have Michael Fleming is next to me. Michael is the Director of Special Projects and Partner Relations at Peisner Johnson & Company, and he is also the Nexus Guru. And we're hoping that you will send in questions and try and stump our Nexus Guru today. We also have Andrew Johnson. Andrew's a partner at Peisner Johnson, and Ray Bigley, who's Vice President of Business Development at Avalara. And on the other end of the panel, co-anchoring this event with me is Alexandra DeFelice. Alexandra is the Senior Manager at Moore Stevens North America. All right, so we are ready to start. What can you guys tell us about the 5 sales tax hotspots that online sellers need to know about?
Well, I think that the first thing to understand is that the marketplace is changing, just like you mentioned, Gail. And in terms of that, there's a couple points that you need to be aware of to protect your clients. And what we're going to talk about today are those points, how you can protect your clients and how you can be prepared. As marketplace fairness moves through the Congress, your clients are going to have questions. And really what the session is all about is for the average accountant that's not a SALT, state and local tax professional, to be armed with answers or where to go to get those answers to reply to your clients. And I really appreciate you guys wearing the Avalara colors today. We're all about orange. And with that said, we'll jump right into the hotspots, and I'll have Andy talk to you. Oh, wait a second. I got ahead of myself. In terms of these revenue gaps, the market dynamics are that the states are short revenue, so they're looking for other sources of revenue. And the revenue gaps are being corrected in particular ways. This particular slide that you're looking at talks about the states cutting back in higher education funding. And you can see Arizona cut back upwards of 48% in their funding to higher education. And that's what they're doing to close these revenue gaps that states have. And so there's a lot of pressure on states to get revenue, and that's what's driving this whole conversation around it. And as we'll talk about, it's driving audits, it's driving lots of activities in the sales tax area.
Is this something new, or has this been going on for a long time?
Yeah, I think that, as you're well aware, as we're all aware, there's been a lot of conversations about revenue gaps the last 5 years. So what's new is the direction that the states are going, because the gaps are getting narrower, but they're also, it looks as if it's going to be prolonged as we've been in the recession longer. Okay. Yeah. So what we'd like to talk about are the 5 hotspots. And those 5 hotspots are nexus, tax rates, taxability, use tax, and exemption certificates. And we'll arm you with the ability to have a conversation with your client on this. And we're going to try to do it in a fun way, as fun as you can make sales tax. Isn't that right, Andy?
But don't set the expectation too high, Ray.
Yeah, yeah.
It can only be so much fun.
Exactly. So do we have a poll question right now? Or wait. So the first thing that happens is your client gets this letter. You're under audit. So what does that mean, Andy?
Well, Ray, first of all, thanks for sponsoring this event and inviting us to speak. It's always a pleasure to share sales tax nuggets with other CPAs. What my mantra is, what I think about when I'm meditating is protecting our clients. That's what CPAs really should do. And so that's the idea here of our presentation. What are the areas that you as a CPA really need to be on top of? You may not know everything about state and local tax and specifically about sales tax, but what are the areas that are most likely to cause a problem in an audit? And should you wait for your clients to get this letter that they're under audit, or should you be proactive and try to protect them against the possible areas of trouble? So maybe it's time for a poll question now, Alex, or? Do we want to ask the boring question or the fun question?
I think this is kind of a boring question, and I mean, there's so many great things going on with this. So, and I think that the point of today is to really educate the viewers. So let's put it a real question, a real life scenario question here.
All right, let's see what you got.
All right, there's a plane. It's filled with salespeople that crashed on the border of Texas and Louisiana. Where do the survivors have Nexus? Is it A, salespeople don't give you Nexus, B, wherever you have salespeople, you have Nexus, or C, there's not enough information? So don't answer this. This is for our viewers out there before you give us the answer.
Right.
So the choice is here, and again, you can look at, you're going to text your results to 22333 or tweet them to @poll. So it's either A, salespeople don't give you Nexus, B, wherever you have salespeople, you have Nexus, or C, there's not enough information, and these numbers on the end here are what you should be texting in or tweeting in. So we're going to give them a couple of seconds for that, and we'll get to the results. So what's the answer?
Very good question. That's an excellent question. I compliment you on that question. And for that, I think we need to turn to our Nexus guru. What do you think, Ray?
I think wherever you have salespeople, you have Nexus.
That's a possibility. So what if the salespeople all crashed right on the border? All they did is lined up on the border. Now what? We better go to the Nexus guru.
Exactly.
I think we need more information. Are they actually soliciting there? I mean, just because a salesperson is passing through a state doesn't mean that they're actually soliciting. So we would actually have to have some more information here.
Is by soliciting, if a salesperson went to a conference and they have a vendor booth there, would that be considered Nexus defining?
It could be. It depends on the state. There are some states that, like a Michigan, if you go to that state for any reason whatsoever, for greater than 48 hours, then that's going to be a Nexus creating activity. Arizona, very similar.
Yeah. And Andy, with marketplace fairness, does that change Nexus? What does that mean for Nexus?
It definitely would change things. You know, if marketplace fairness were to pass, or when it passes, or however you want to term it,
Sure.
it will definitely increase areas where you have Nexus. It won't do away with these rules that we're going to talk about today. It'll just, you know, when simplification happens, Ray, what happens with taxes?
Yeah, for the accountant, they get more complicated.
Oh, yeah. It's only going to make it worse.
Yeah.
Right?
Yeah.
So let's go ahead and talk about Nexus, though. So we started with this great poll question, where you have Nexus. Well, Nexus is this concept of wherever you have enough contact with the state, they can force you to pay their taxes or to collect their taxes. That's what Nexus really is all about. And that's what CPAs have to know about, is where do my clients, granted they have Nexus in their home state where they have employees, but what other activities create Nexus? Could it be that salespeople create Nexus? A lot of people are shocked that salespeople create Nexus, but it's true. There's a long line of cases that show that even one independent sales rep who is not an employee and isn't even your exclusive rep can create Nexus for you. That's your Tyler Pipe case, Ray, that you were mentioning.
Yeah, in the state of Washington.
That's a U.S. Supreme Court case. And a lot of CPAs are shocked at that because they know that wherever you have buildings, wherever you have employees, that's Nexus. But they sometimes don't know that even where you have independent salespeople, non-employees, creates Nexus for you.
So what about a blogger? What if I hire somebody as a blogger, Mike, and they're blogging for me, for my company? Does that denote Nexus? Would that be a Nexus creating activity?
It could be, Ray, and there are many activities that pretty much every state out there is going to look at as a Nexus creating activity. And then there are those activities that are going to be different from state to state, and this is one of those situations. If all they're doing is blogging for you, then in general, that's not going to be a Nexus creating activity. If they have some sort of link on their website and are steering people to your website and you're paying some sort of commission or fee for that, then that would be a Nexus creating activity in a number of states.
And so just like advertising is not a nexus creating. If I hired somebody to advertise for me in a state, that wouldn't be nexus creating, and that would be the blogger in the first example. In the second, they would be tied to revenue generation or lead
It
generation.
goes a little bit deeper than that. It depends on what type of advertising. Advertising directed at a specific market. So if it's advertising directed within the state, that could be a nexus creating activity, depending on the state. But national advertising, which a blogger would be doing, is usually considered not to be a nexus creating activity.
I see.
So that's really simple. It could be, it can't be. How do you, so how do you educate your clients on this? And again, it's not to make them be the gurus, but it's to have them have the Cliff Notes version so that they can at least maybe put some fear into their clients that might be at risk. What should they be telling them without confusing them?
I think I have the answer for you. For all CPAs, this is how I approach it. To me, it's, thinking of Joe Biden, there's 3 words you really have to know. That's be careful when it comes to Nexus. Is that right? You don't want to be too aggressive and say, oh no, we don't have Nexus anywhere. We just have Nexus in our home state. The problem is, as the slide shows, over time the problem just gets worse. So if you have Nexus someplace and you didn't think you did, but you should have been collecting sales tax all along and you didn't, then the state comes back and audits you. This is what you don't want as a CPA, and says you should have been collecting tax for the last 6 years. And now you owe us all those back taxes that you failed to collect at the time of the sale. So you don't want to be too aggressive when it comes to the sales tax nexus. Be conservative, be careful.
And penalties and interest.
Oh yeah, well that's insult to injury.
Alexander, do we have poll results?
Everybody chose that wherever you have salespeople, you have Nexus. So that seems like that's not the right answer.
Well, actually, I congratulate them for choosing that, because that is a good conservative approach, but not necessarily wherever you have salespeople. It's just what are they doing there?
Yeah.
If they're there consistently, then yes. If not, probably not.
I have a question. If the people on this webinar today are going to talk to their clients, it doesn't make sense to talk to everyone. What would be good industry segments that they should go after that would be open to this kind of thing if they're going to pick and choose a few clients to talk to about this?
Well, the best resource for CPAs is within their existing client base, because that's the ones they know. And in their annual review, before they do the tax return, just do a little bit of a nexus review. Where else do you have activities? We're only filing for you in this state. Where else do you have employees? Where else do you have salespeople, even independent reps? That's the place to look. And of course, if you can offer that to your prospective clients that you're targeting, sure, that's cherry on the milkshake.
Yeah, and one more case on Nexus is the agent, the agent fee. So let's say you're selling an item and you only give your customer one person to do installation work. Would that denote Nexus? It's an agent, it's not an employee, but some states would view that as Nexus defining, Mike, or not?
Absolutely.
Yeah.
Some states have very low thresholds for what actually creates Nexus. And pretty much any activity that helps you to create or establish and maintain a marketplace is going to be a Nexus creating activity.
Okay.
So,
Dear Diary, my boss just yelled at me and told me we're down in Q4, so I need to get an interception and score a TD. I have no idea what that means. I was a drama major.
Dear Diary, things got a little out of hand at the last trade show. Now everyone calls me Bam Baby Booble Bangin' Weasel Shank.
Dear Diary, it's been 2 weeks and I still haven't heard back from the well-spoken Nigerian prince. I am sure that he has received my bank account information by now and has had time to transfer the money.
Dear Diary, I just started the paleo diet. It's the one where you eat nothing but Flintstone vitamins. I feel nauseous.
Dear Diary, to add color to my day, I have started conducting psychological experiments on the interns. Day 5. I can now make them cringe when I walk by. By Friday, I will make them weep silently by raising my eyebrow.
Oh yeah, tax rates is a really big deal. And a lot of times when people think about sales tax, they think about, wow, what rate should I charge? Do I charge my home rate? Do I charge that other city rate? Well, how many jurisdictions do you think there are, Ray?
Well, I can see it. There are 11,000 jurisdictions in the United States,
That's
North
just
America.
a number I threw out there. Because I've heard people say 8,000, I've heard people say 13,000. So I said, all right, I'll go with 11,000 jurisdictions. If there's 1,000, that's a lot. So every one of those jurisdictions can have their own sales tax rates. And yes, it generally depends on where you're shipping to. That's usually the rate that matters. And so if you ship to a lot of places, you have to make sure you know the right rate. The real danger that CPAs need to be aware of when it comes to sales tax rates is they need to make sure their clients are not under collecting the tax. Because if they under collect it, so let's say they collect 5% because that's the state rate, but they don't collect the 2% because that's the city rate, and they didn't know about the city rate when they Googled it, it just said 5% is the state rate. So they have their clients collecting 5%. Well, 5 years from now, the state audits their client and says, hey, you should have been collecting 7% all this time. So now you owe us that, Gail, plus what? Penalties and interest, right? Plus penalties and interest. You owe us all that tax you didn't collect. That's the biggest tragedy of sales tax. That's what we're trying to avoid. So that's the hot spot. Because what happens when clients have this problem? What do they say? Oh, that was my bad, my bad. No. They usually look at the CPA and say, hey,
It's your
you're
fault.
supposed to know this.
Tell me.
Yeah.
You are my tax person.
Yeah, bring me good news.
Even though the CPA caveated it all over the place, we don't do state tax, we don't do state tax, the client still says, hey, you should have told me this. This is like obvious, right? So that's the thing to remember. Yes, there's tons and tons of rates. This is a great place to automate too.
Yeah, I think that, sales tax rates, the lay people and your clients think of sales tax in terms of rates. But really, the complexity is not only rates, but combined with product taxability that we're going to talk about next.
All right.
And obviously, Avalara is sponsoring the session, and we handle both of those areas. We tend to talk a lot about rates because people think of sales tax in terms of that. But the real complexity often lies in product taxability. And I know that you guys have some examples on that. Mike, being the Nexus guru, also knows about product taxability as well.
Yes, we're going to come to you, Mike, with some really tough questions. Get your brain thinking, because we're going to try to stump you ourselves. Ray mentioned that tax rates is one thing. Nexus we've already talked about. But what about, is the thing I'm selling even taxable? It's not a guarantee that it's even taxable. So you may not even have to worry about Nexus anymore. I'm a CPA, and we do CPA services. Not your typical CPA services, but I don't have to really worry about where I have Nexus. I travel all over the country, but I don't care. I don't care about the tax rates either.
Because services aren't taxable.
Because my particular services aren't taxable. So that's what I think where taxability fits in here. You don't necessarily have to panic just because you have salespeople over here or you have employees over there. It's not necessarily the end of the world. But if what you sell is taxable, that's the next big thing to decide.
So we're in this online world now, Mike and Andy, and you're selling on Amazon or eBay or something like that. And you click the box and you say, I'm selling tangible items and they're taxable. Now what happens? What's the situation that happens oftentimes that you guys see?
If you are selling through, let's say, Amazon, fulfillment by Amazon, or even if you're using Avatax to calculate your tax rates, we've seen examples where people just say, oh, okay, let me just click this box that says, yeah, I want to collect tax. Of course I want to collect tax. Mike, give us your example you were talking about earlier.
Yeah, it's not just with these online companies either. We had a client come to us the other day, and for the last 8 years, they've had collected, not remitted in the state of California. And the way that this came to light is their bookkeeper got fired, and they realized that she had been making adjustments and moving everything to the general ledger at the end of every year. So there's lots of reasons how this can happen, but it's a big, big issue. As tax collected, not remitted, is one of the cardinal sins when it comes to sales tax.
And what are the consequences on that?
Depends on the amounts involved. I mean, you can step forward and get it remitted to the state as soon as possible. However, the states will sometimes pursue criminal penalties. And the state of Florida is one that is very, very aggressive with very low thresholds. You know, in some of these states, you're looking at $5,000 to $10,000, and that's a criminal penalty.
I see.
So let's say a year has passed and suddenly you realize, I forgot to collect sales tax, and you don't want to have the penalty. Are you going to be lame and write notes to your clients and say you owe me 25 cents or whatever it is? Or can you, as the CPA firm or the owner of the company, can you just write a check for that amount yourself?
It's an excellent question. There's two different things we're talking about. A situation where you just didn't know you had Nexus and you didn't know what you sold was taxable, or you were charging the wrong rate. Then yeah, a year later, you would have to pay that money out of your own pocket. You could go back to your customers. You may decide you don't want to go back to your customers for a lot of reasons. One, it could be a bunch of customers, which is a little, pennies per customer. Or it could be one of your top customers that you just, the marketing people are like, no way are we trying to do this to this customer. And in that case, it ends up coming out of your pocket. That's only 1 year, but the state can go back as far as 10 years. They often do. And so that can be devastating. If you think of, say, you're making $10 million worth of sales over a 10-year period, which isn't that big, and at 8%, we're talking about $800,000 potential exposure. And that's $800,000 you could have collected from your customers had you only known, had your CPA alerted you to that hotspot. And then so the state comes back and says, well, you owe us $800,000. It's not necessarily the end of the world yet either. There's mitigating things that you could do. For example, you mentioned one of going back to your customers. It's not necessarily being lame. The customers sometimes already expect that. And in fact, when you go back to your customers, they may say, oh yeah, no problem. Don't worry about that because we already paid that tax ourselves. We're going to talk about the use tax thing. A lot of times that's what you find because you're going to go back to your customer and say, I'm so sorry. We neglected to charge you tax and now we're being audited and so we have to collect it from you. And the customer says, oh, let me just prove to you that I already paid it. So it's not necessarily too bad. But that $800,000, that could be devastating to you as a small business because you may not even made $800,000 profit on those sales. It's a tax on your gross receipts, not on your profits. And plus they add interest and penalties. Well, interest going back 10 years, you might owe 60% penalty and interest on that $800,000. So now we're talking about, what are we talking about? $1,300,000.
And how open are states to negotiating those interest and penalties when you've got someone coming in and, here I'm ready to make good for the last 6 years worth of taxes?
If they find you first, they are not open at all. If you find them first, if you go to them through a process, usually it's a process we call voluntary disclosure. So if you go to the state and say, oh, you don't know who I am, especially if you go to them anonymously, you don't know who I am, but I've been doing business in your state. I would like to come clean, but I don't want you to go back 10 years, and I want you to waive penalty and interest. Then they are open to negotiation. It's not like you have super leverage over them. You don't, because they feel that they're going to find you anyway, but they don't. They're happy to bring you into the system, and they will limit the look back. So if you've gone back 10 years and you have this $1.3 million, then you could have them only go back 3 or 4 years and knock off $700,000 or $800,000 of that liability by going to them first on an anonymous basis.
I'm assuming, is this a case-by-case basis? I mean, do some states have, I'm assuming some have voluntary disclosure programs, and that's obvious because you just fill it out. But what if they don't? Should you be going with a lawyer? What do you do?
Yeah, I was going to say there's a difference between voluntary disclosure programs and amnesty, but we're going to get way deep into this topic.
But this is good stuff, Ray.
Yeah, I know all sales tax stuff is good stuff. It's just riveting.
We have a question for the Nexus Guru.
Oh boy.
Okay. I operate an online retail business and I make a sale in Idaho, not my home state. I have a small warehouse, more like a shed in Idaho, but the warehouse is empty and I'm shipping from Louisiana. Nexus or not?
When you say a warehouse, is this being used in the business? That would be the follow-up question that I would have there. If there's any inventory being stored in the state or the warehouse is being used in the business, then that would be a nexus creating
And it wouldn't
activity.
even have to be inventory that's being delivered to Idaho. It could be inventory
Correct.
that's delivered to another state.
Yeah, if you're storing inventory there for any reason whatsoever, even for sales outside, like Ray said, it's probably going to be a nexus creating activity. But it sounds like he may not be doing that, so there would be some follow-up questions that we'd have to ask.
And that brings up this whole issue of fulfillment by Amazon. And it's been in the news a lot recently. Amazon, negotiating with states to put warehouses there and getting tax rates and so forth. But now they're collecting tax where they have warehouses. And gets back to the point that we talked about earlier.
A big issue with fulfillment by Amazon is you may be shipping your inventory to just one warehouse. And you may not even know that having inventory in that state is nexus creating. And just about every state is going to consider that to be nexus creating. But then Amazon, in their agreements, can move it to any one of their warehouses. So instead of having just the nexus in the one state that you ship to, Amazon currently has warehouses in 14 states that charge a sales tax. So now you have nexus in 14 states.
And they don't tell you where your inventory is.
Not beforehand. You can pull reports and figure out where your inventory is.
Yeah.
We are Avalara,
We were born of the internet revolution.
bringing technology to bear
on an age-old manual process.
Helping businesses comply with their sales tax burden.
We know that businesses struggle with their governmental compliance.
And we have a strong belief
that technology eats bureaucracy.
We strive to live up to our promise.
to create the fastest,
Easiest, most accurate,
And most affordable way.
for a business to calculate and remit transactional taxes.
We live to make sales tax less taxing.
Our main competitor is folks that do it themselves manually, and that's certainly not the most compliant way of doing things.
We get the government off people's backs. Governments everywhere create this incredible complexity of all these rules to follow, forms to file, tasks that they give businesses to follow that businesses have to do. And one of the things I love about what we do is that we take that away from business owners so they can just focus on running their business.
It's so complex and there's layer on layer on layer between the jurisdictions and the rates and the products and the exemptions, and to have every single person manage all of that with all of those rules seems like such a waste. Why not get it all together in one place and let everybody access that knowledge?
A lot of our competitors are selling rates and not selling a complete solution. We truly offer an end-to-end solution for sales tax compliance, from calculation, managing certificates, to filing returns, end-to-end done.
Who could imagine a scenario where in the future, interacting with government is actually a beautiful experience? That's part of Avalara's mission, and that's part of the technology challenge that's above and beyond just adding together a handful of numbers and putting them on a tax form.
I've always been proud of the way we still reach for the culture of the customer. We do a little bit more, and we spend a little bit extra time, we take that extra step to help our customers, and that's true across the board.
Using technology to remove burdens from people is a good thing. I mean, we should all be able to have technology remove irritating parts of our lives, so it's fun to be able to make that happen for them.
The challenges that I see on a day-to-day basis are what really get me amped up.
What excites me most about coming to work every day is the fact that we're always doing something different.
I love the new problems to solve, and that's what gets me up in the morning, and there's always a new problem to solve here.
It's always fresh. There's never that feeling that you're just doing the same thing all the time. It's always a new challenge, new products, new features, something new coming to the plate.
The company becomes more sophisticated each year. more mature each year, yet I still love that we're still innovating.
We're not shying away from the opportunities to take big risk in new areas and launch product very quickly to the market. That's a fun and exciting work environment, and I'm happy to be a part of it.
Okay, so what's our next sales and use tax hotspot?
You know, before we jump into use tax, there was some questions on product taxability. And Andy, perhaps you could, really net it out and give some examples.
Okay, let me just try to wrap it up with this overall. I'm an Arthur Andersen alumnus from a long time ago.
A firm just bought their name.
Really?
They did, just like a couple months ago.
Think straight, talk straight.
Exactly.
Moment of silence.
Yeah.
Where was I, though?
No, you're going to talk about product taxability. You're going to net it out for us.
When I first started this whole business over 22 years ago, I remember thinking, I know this is like Greek to me. So I just want to boil it down. When it comes to taxability of products, just remember that tangible personal property, stuff like, these glasses, a desk, a chair, these things are tangible personal property. They're not real property. They're not intangible stocks. Tangible personal property, if you sell that, it's taxable unless the state has some very specific exemption. So there's exemption, for example, for things like foods, because nobody wants to tax food because even the very poorest people have to eat, right?
Yeah.
But every time there's an exemption for a particular item like food, then someone has to draw a line. What's food and what's not? So Ray, is a donut, would you consider donut a food?
For me it is. For me it is.
Well, the states have very interesting rules. So I'll just give you one, for example. And we're going to turn to our expert on donuts here in a minute. But in a lot of states, one donut is not considered food. It's considered meals ready to eat, whereas a dozen donuts would be considered food.
Oh, I get it.
So Mike, am I right about that?
Yeah, Mike, it looks like you're an expert on this.
Yeah, I just don't like paying sales tax.
So you buy the dozen?
I go by the dozen.
I see.
It's cheaper by the dozen. We got no sales tax.
I see. Another example on taxability and use tax is Home Depot had a case, and this was really a case of over-collecting. And Andy talked about the important thing to protect your client is under-collecting. But this case got a lot of news, and it was in California, and Home Depot was selling fertilizer. Well, fertilizer is categorized in a couple of different ways. If you use fertilizer in an agricultural setting where you're growing vegetables, it's not taxable. And so in California, people were buying fertilizer. It was for vegetable gardens. They would put it on their garden and eat the vegetables. There was a lawsuit, and Home Depot had to rebate taxes and do those kinds of things, all around product taxability on fertilizer.
Right, because there's an interest from the state legislature to protect agriculture, right? So that's so they pass a law that says items used in agriculture are not taxable. All right, then someone has to define that. Well, what about fertilizer for your garden? Oh, that's agriculture. What about fertilizer for your lawn? Well, that's not agriculture, so fertilizer for your lawn. So a company like Home Depot, any retailer, your own clients have to make these decisions. That's another area where Avalara really shines in the automation of it, because you can go in there and select product taxability codes that match up with your SKUs or the items that you sell, and then Avalara maintains the tracking of those items, whether they're taxable in what jurisdiction. It's really an amazing product. How many codes are there? There's thousands of codes, right?
Yeah, and I think that, back to this point, when people talk about sales tax, they think about it and they talk about it in terms of rates. And that's the way your typical client thinks about sales tax. But from an accountant's point of view, product taxability is equally as complex. To give you an idea, we manage over a million product taxability codes, across medical equipment and food items and different ways of delivering computer software. All are very granular in their look. And because we have 50 states, they're taxed differently across the country, and people know that. And so the complexities in product taxability from an accountant's point of view are oftentimes more difficult than the rates themselves, because we have automation for the rates.
That's where the tricky part is. And just to wrap it up, so tangible personal property, taxable, unless there's some specific exemption like food. However, services are not taxable in general unless they are. So certain states, California taxes no services, but Texas or Connecticut taxes a whole bunch of services. So if you're in a state that doesn't tax any services, you tend to think, well, services just aren't taxable.
In fact, I have a question for the group. There are 2 states that tax accounting services. Does anybody know what they are? Or who they are? Which states? Take a guess. Do you like to go to where it's sunny and it's an island and you can relax? Hawaii?
I didn't know if you wanted me to answer.
Yeah, no.
Who else is going to answer this one?
Yeah, no.
I've got my sunglasses on, so I'm
That's right.
signaling
so
something.
Hawaii and South Dakota tax tax services or accounting services.
Yeah, so even accountants can be taxed in certain states.
That's right.
Obviously, there's not enough accountants in Hawaii or South Dakota to fight that, right?
Yeah, yeah.
All right, that's taxability. Have we said enough about taxability?
We have. And, I think we'll move on to the next hotspot, that's use tax. If there's something that's more exciting than sales tax, by all means, it's use tax.
Oh, yes. This is true.
It really is. It's a riveting topic.
This will get your motor running for sure, yeah. The thing that I want people to understand about use tax is, Ray, and why it's such a hot spot is you can guarantee in a sales tax audit that the auditor will look at things that you buy. Yes, they'll look at what you sell, but they'll also look at everything you buy. So you might be totally focused on I'm an online seller, should I collect tax? Well, what if you're an online buyer, and so you're not paying tax to your vendor. Why? Because that vendor is just illegal? No, because the vendor doesn't have nexus in your state. So that's why they're not charging you sales tax. But do you as an individual or as a business owe that use tax? The answer is yes. Nope, it doesn't even depend, okay? So finally we have a question the answer is definitive. The answer is yes. But does the state audit individuals? Not usually. I mean, we just had a case of a client of ours called up and said, hey, Arizona sent me a bill. How much was that bill? Was it $3,000 or something?
No, it was about $5,600.
$5,600. This is just an individual because she had purchased cigarettes online from somebody with no cigarette tax. And so the cigarette vendor got audited, and they got a list of everyone they sold to and sent bills out to people. All right?
30,000 individuals.
30,000 individuals in Arizona.
7 years worth of back taxes, sales tax, luxury tax.
So that's coming. That's very uncommon. It made news because it's so uncommon. But businesses, it's not uncommon at all for them to be audited for purchases where they did not pay the sales tax or the use tax to the vendor.
Okay, and in terms of use tax, I think that it will become more common as we have further conversations around marketplace fairness. The thing that's really important to understand is with marketplace fairness, it's really not a new tax, it's an uncollected use tax. States just don't charge individuals, and just like Arizona did, state of New York, state of California, they have projects right now where they're evaluating how they collect use tax if Congress doesn't act on marketplace fairness. And so it's something that every accountant is going to need to be aware of. Your clients are going to come in and ask questions on this. And to your point, I think the other thing is the way that you get caught on this is from whom you're buying from, they're audited. You're not audited yourself. They're doing an audit on somebody that you're buying from, and they look at those transactions and find them.
Yeah, that's a question that comes up all the time is, all right, I might have Nexus, but do I really have to worry about this? Am I going to be audited? I'm such a small company. I don't know. I just know that sales tax audits are much more frequent than an income tax audit. The chance of being audited for sales tax versus being audited by the IRS don't even compare. But that's not even your total concern, because if you sell to a large company, if you have customers that are large companies, you're an online seller, then you can guarantee your invoices are being seen in their audit. Because the auditors are not only looking at the big company's sales, they're looking at the big company's purchases. And so in this use tax hotspot area, what a CPA really has to know, or just become reconciled to the idea that their clients really do need to be paying use taxes. It's a bad news thing, and nobody likes to be the bad news bearer, you know? But it's a worse news if you didn't say anything, because when they get audited, they'll say, hey, you should have told me. And here I am paying use tax on things that I just didn't know about. So it's just, that's the main point. Make sure your clients have a system for paying that use tax on items that the vendor didn't charge them tax.
So is it likely that many states are going to really start finding a way to aggressively go after that tax?
I think to Ray's point, it kind of laying this out at the beginning, is there's budget shortfalls all over the place. That's the last thing they want to do because they're taxing their own citizens.
Exactly. So let's look at the political dynamics of this conversation. That's really what it gets down to. If I'm a state legislator, I don't want to impose a use tax on my constituents. I just don't want to do it.
Even though it's technically the law.
Even though it's the law. When I graduated from college and filed my first tax return, I self-assessed use tax on an item. I was so proud of myself, and I haven't done it for the last 40 years. I'll probably get in trouble. Exactly.
You're on TV, Ray.
Exactly.
There's auditors watching.
So I think that nobody does, huh?
Yeah.
And I live in the state of Washington where there's no state income tax, so there's actually no way of reporting it. But the bottom line is this, is as the conversation moves along on marketplace fairness, it's pivoted to this is not a new tax, it's an uncollected use tax. So use tax on an individual use tax, consumer use tax level has gotten some attention. And especially in the state of New York and in the state of California, they've moved further along in how they would collect that. And in fact, even in Congress, they talked about last spring, there was a congressional hearing in the House, and they talked about options to marketplace fairness. So marketplace fairness was going to use existing sales tax systems and so forth. And one of the options was to create a clearinghouse. This gets to the whole NSA issue and so forth. They're probably already collecting this information, huh? But to create a whole clearinghouse of credit card transactions. And that federal clearinghouse would give those transactions back to states, and they could self-assess use tax. Mm-hmm. So it's been discussed and talked about. I would be surprised if it went that direction, but there's discussions around it. Mm-hmm. Do we have a poll question?
We do. In the spirit of the season, the question is this. A Christmas tree farm gives away Christmas trees to the underprivileged people for free. Does the farm owe any tax on the trees given away? Yes, no, or maybe. And I will show you the numbers that you could text in here. So again, you're going to text it to 22333 or tweet the answer to @poll. So if you think that the Christmas tree farm does owe taxes, you will tweet or text this number, no or maybe. And the results are going to start coming in now.
Okay.
And what's the answer?
Well, but this is a great question because this comes up all the time. You might not have any clients who are Christmas tree farms, but you do have clients who are coffee houses, who are restaurants, who sell all manner of things, right? And they typically have some deal for their customers, or not for their customers, for their employees. In this case, it's a Christmas tree farm giving them away to underprivileged people. And so, is there a tax ramification, Mike?
Depends on the state. Some states will
Did
actually...
you say depends?
Okay. Unfortunately. But a number of states, when you're removing items from inventory, will actually consider that to be a taxable event.
Yeah. And you know, a perfect example of this is for those of you that go to Starbucks occasionally, you can see the baristas come out and they don't pour their own coffee behind the counter. They come out and they wait in line and then they give their code and their sales tax collected on that transaction.
Right.
So Starbucks is aware of this and they treat their employees that way. They get a discount on the transaction, but they do pay tax on the cost of it.
So they have to have a system for tracking items given away or so that they can pay the use tax. Now, the manner of the use tax or the calculation of it varies from state to state. Sometimes it's on the fair market value of the item given away. Sometimes it's on the cost of the item given away. There's another, little aspect to it. We said that sometimes there's exemptions in taxability for agricultural products. Well, so this Christmas tree example is really good because Mike said depends. It depends on the state. Well, it also depends on the item you're giving away.
Yeah.
So in this case, the answer really is no, depending on the state. It's more no than maybe, okay?
Yeah.
Because they're giving away an agricultural product, which by its nature is usually exempt.
So if I was giving away coffee, it wouldn't be that way if I was Starbucks giving away coffee.
Depending on the state.
Well,
Some states see
yeah.
coffee as food, some see
Okay.
it as
Yeah, a
not
single
food.
cup. A single
Right.
cup. Yeah.
So
Although
if
if
you
you
were
were giving
drinking,
away the coffee beans from your
That's
coffee
right.
farm, that would be more like the Christmas tree, right?
could be, Gil. Could be.
Yeah. Well,
So
Okay,
what if you are not giving away your own product? What if you're giving away the swag?
Now that's a really good question because a lot of people give away swag. They give away a little bit nicer swag than this usually.
The shirts are great.
Oh, see. But that's a real issue because they do have to accrue use tax where that item is given away based on the cost of that item. So yeah, giving away samples of your product, that's a use tax issue. Even you're giving it away to charity, you think, hey, I'm giving it to charity.
Mm-hmm.
It's a deduction for federal tax purposes, but there's a use tax consequence.
Okay, let's move on.
We're running short of time, but exemption certificate management is a hot area. And, you know, I think that it's a low-hanging fruit for auditors, and we all need to understand the dynamics that's happening and how, you know, maybe 15 or 20 years ago, an auditor would come in and say, hey, you don't have an exemption certificate, and give you time to get them. Now they come in and they say, hey, you know, you're not compliant, you owe us X number of dollars, and it becomes a negotiation with the state.
And just to back up real quick, because I know from my own experience, I didn't even know what exemption certificates were when I was just a regular CPA.
Yeah.
But if you sell something to somebody, you know, tangible property is a good example, it's always taxable unless it's exempt. So if it's for resale, you either have to collect a tax or you have to collect a certificate.
Number.
And if you don't have the right certificate in place, then you owe that tax yourself. And it's low-hanging fruit because an auditor will come in and say, all right, give me a list of every sale you made that you did not tax. Okay, here's my list. They come right back with that list and say, okay, I want certificates proving that all these sales are not taxable. You have to have the right certificate. And if you don't, it's very easy. They didn't have to do any work at all, and they can generate a big assessment, especially if it's a projected sample.
Who gives you these certificates on the spot if you're out on it? I mean, are you supposed to have a printer with you? What can
Well, there's all kinds of ways.
buyer,
One is
yeah.
having a printer, but your customer has to give you that certificate. So one approach is to say, I always charge tax unless they give me a certificate. So that's why certificates are a big deal, and certificates, particularly in a drop shipping situation, is a real big complicated area beyond the scope of our presentation. But those are the 5 hotspots.
Yeah, and that's the way that states find things out, is they go in and do an audit. They audit a drop shipper who actually has nexus in a state, and they say, you're not collecting tax. He goes back to the seller, and it becomes a morass of a conversation. And I think that we're at the point where we have to wrap it up. Isn't that right?
Yeah.
Yeah, so, you know, we talked about the 5 hotspots. These are the areas that you can use to protect your clients. If you have any questions, you know, feel free to ask Peisner Johnson. Avalara can also answer your questions, or we'll refer you to somebody like Peisner Johnson if you're in a different geographic area, perhaps. But we appreciate your time. We know sales tax is exciting. We love it. You guys, thanks a lot for wearing the items and the gear.
Thank you, Avalara, for sponsoring this session.
That's
we
right.
Really enjoyed it.
Yeah, we love our glasses.
I'll take some of the swag.
Yeah.